let's talk private equity now. I don't have to introduce anybody because the voice of God did it already. What I like about this panel is that we have LPs and GPs on it. I think it's a good, a good starting point for a good discussion. I hope you will disagree a lot. Imogen, I would like to start with you. Obviously the whole environment for private equity has changed. Some people say making money for private equity firms has been easy as well for investors. If I had 20 million now, should I still allocate into private equity?
Well, of course you should, Jan-Henrik. The private equity industry obviously has experienced a lot of growth over the last 10 years. I think annual distributions are around 23%. That has paused somewhat, so at the end of 2022 that had roughly halved. But I don't think that changes the overall attractiveness of the industry. Fundamentally, we're investing in good companies that are being well managed with significant growth potential. So I think there's a lot of exciting things to invest in the private equity.
Growth, although it's tricky at this stage. I mean, Kurt, you're a big tech investor. If you look basically, if you think about the SVB fallout, right? Like lots of people talked about the mismanagement here of assets and liabilities. But it's also a story of over-concentration to this tech sector. What's your take on that from the tech investor perspective?
So I'll start with a slightly longer perspective, which is that when I joined the industry in 1996, I was warned that it's too late to join the private equity industry because all the good investments have been done and there's too much capital chasing too few deals. That was the story then. And then in 2008, when I was asked together with a partner to take over the leadership of the firm at the time, the story was the same. There was an article written somewhere which said, well, good luck, guys, because the golden era is over and it's going to be really, really tough. And yet we've had the best decade of investing, give or take, behind us. And our industry, at the end of the day, we thrive on a certain level of volatility in the market. So we can choose when the markets are very strong. We can choose to be sellers and benefit from that environment. And when the markets are full of fear, when the markets are risk-off, and crucially, when there's a need for long-term patient capital that can actually drive different outcomes. That's when private equity comes to the fore and when there's a real role for us. So that's kind of the macro that we're talking about. In terms of tech valuations, so I started my career in the late 90s dot-com boom and then very severe bust. And you could sort of see a redo of a better sequel of all of that through the last 5 years or so, where you had a lot of herd behavior, where anything that you could label as technology suddenly became a so-called unicorn. I always hated the expression. And there was a lot of tidal capital that came into the sector that then drove the valuation environment into a self-referential place. And now we are seeing the reset on that basis in very much the same way that we saw the reset in 2000, 2001, 2, and 3. And that reset it's very discriminating in the sense that it creates, on the one hand, it just shows that some companies were never very good and should never have had access to that much capital. But on the other hand, it also creates some fantastic investment opportunities. Because we know, like if there's a few things you know for sure, and one of them is that over the next 20, 30 years, the onslaught of technology-driven both growth of and creation of profit pools will continue. And if you invest in the right companies, partner up with the right entrepreneurs and the right management teams, and you help that happen.
That said, though,
then you can do really well.
You cannot deny the fact, I mean, obviously you saw the inflation data, rates will continue to rise, and I think it's very clear that financing will be more challenging. KKR is a good example, I think, like when, pandemic kicked off, you deployed a lot of capital. Now, kind of, it's another crisis moment. Philipp, what's still possible in terms of deal making at the moment? What do you feel comfortable with?
First of all, thank you for having me on
Always.
This interesting day. We'll see what the Fed does today. A lot of people focus on it. I agree with Kurt. At the end of the day, what we do is being micro investors and long-term investors. We are thriving when everybody else is afraid. It's also true if you remember what Warren Buffett says, when the tide comes out, you see who swims naked. Unfortunately, a lot of people have actually swum naked. And that's not surprising when you had $4 trillion of money printing during COVID, that a lot of exuberance entered the system, and people, as Kurt said, really mistook overall exuberance with a sound investment strategy. What really differentiates you in this market now is first a long-term perspective on the underlying segments. So during COVID, we bought the largest hospital company in France, for instance. People thought we were absolutely crazy. But our healthcare team on a global basis had done a lot of work on the sector. And while nobody had any idea how we got out of this pandemic, whether that's 12 months, 18 months, 36 months, we knew that over 5-7 years it would be fine.
It was binary.
It was binary, and overall we also have, the ability to add to our companies in terms of operational experience. We had owned HCA before, so we knew how to run a hospital company. So there's to your earlier question, what deals can get done? The number, and that's my second point in terms of the overall trends right now. So the first being thematic investing, the second, you want to be able to partner. It is much less likely now that you can convince people to sell you 100% of something, because people will be afraid that that's not a great moment to sell 100% of something, given the turbulence in valuations. But if you can convince them to partner with you while still maintaining a significant share in whatever it is they bring you in on, and participate in the future value creation, then that's a really sound value creation. And we at KKR, over the last 15 years, as you know, we have done 3 quarters in Europe deals in that category, and are very much convinced that this will now be the category that will be outgrowing others in the next 5 years.
Another trend is clearly that the number of public companies is falling, whereas kind of private markets is growing. That's a clear trend, and also basically institutional investors allocate more to private equity. In terms of deal sourcing, Kurt, how do you feel about public markets now as a source of deals, basically?
We feel very good about that. So of the last, just as a little microcosm, of the last 6 control buyouts that we've done, 3 of them have been public to privates. That's more than trend. That's more than average. We believe that especially in this kind of environment where the public markets are in need of liquidity, sometimes struggling to make sense of all that is changing rapidly, and it's very hard to understand the baseline of how companies are dealing through this period of inflation and volatility, for example. Whereas that's kind of our bread and butter, we have seen a lot of opportunities in the public markets. That doesn't mean that the public markets on average are cheap, but it means that when you look at the bell curve of distribution, there is that tail of companies which we think are incredibly high quality, and where with a long-term strategic ownership mindset, you can drive really good value. So in this kind of environment, what tends to happen is that the public markets correct first, and they correct first without discriminating too much between companies. And then the second thing that happens is that corporates start thinking about their portfolios and either buying or selling. So it can be both an exit environment or an entry environment for us. And then the third thing that happens is that ultimately, at some point, those private equity or financial owners that sit on assets, they sort of rebase their expectations and say, okay, well, maybe this asset is worth a bit less than what I thought it was worth before. So there's a fairly repeating source of opportunities, I think, that comes out. And I totally agree with you, Philipp. The kind of partnership opportunity is very high at this point.
We only have one problem. If you think about, I don't know whether you guys know where the S&P 500 was at the onset of COVID. It was actually at 3,200. We had 4,000 this morning. So what has happened since COVID? Has the economy grown? No. Are we in a safer geopolitical situation? No. Have interest rates remained low? No. So how can we justify 20% higher stock markets? So Kurt is right. This will be a really interesting investment strategy, but we haven't seen the end of a significant correction in the stock market, most likely.
But it's also an interesting point around how public market valuations compare to private market valuations.
Correct.
I think we've seen some reductions in tech valuations in the public markets that don't seem to have really followed through yet to private markets. And obviously we've got that lag on valuation, so we're always reporting behind where the public markets are. So it'll be interesting to see how quickly that follows through into private markets, or if indeed it does follow through. I think historically private equity has been much less volatile and much more smoothed because ultimately we're a long-term investor, so we don't have the same kind of dynamics that you might have in the public markets.
From what you see,
We have, sorry, Imogen, we have a take on that data. It's not super accurate, but our data would indicate that there's between 18 and up to 36 months of lag between a public market correction and where new private equity investments start happening, which is why just being super patient and stable, keeping an even keel and not staring at the screen, trying to pick the bottom or trying to think that this is too expensive at this point, but just finding great micro investment opportunities that you think you can be a great investor for and keep on deploying through that.
And you've got a very different type of universe in the public markets too than you have in the private market space. You've got much more diversification, many more opportunities in private markets. So actually public market valuations don't necessarily always translate into what those private valuations should be.
And what do you see from your portfolio? Do you feel like returns are also coming down now in private equity funds or in private markets?
Because if we look at the latest valuations, which is Q4, buyouts have actually been pretty flat. So we haven't seen any
as a strategy buyouts.
As a strategy from Q3 to Q4, valuations were pretty flat. Venture has come down a bit. It'd be interesting to see actually what happens as a result of, obviously the SVB fallout has been actually relatively contained, but they have had, they do lend to that venture community. So if that is pulled back at all, it'd be interesting to see if that has an implication on valuations because of companies' cash positions. So I think we may potentially see more valuation falls in the venture space, maybe some in buyouts, but there's no evidence of that so far.
I don't think the book is anywhere near written yet on what the performance of over the last 5 years of different classes of private equity.
I mean, I guess the only thing we know fundamentally, and that's the reason, Kurt, our asset class exists, you have significant moral hazard issues in the public markets. Right? Poor corporate governance, poor performance that is not immediately actioned, with changes in management has led us into this current crisis in the banking world. And, this is a good example where active ownership, like the active ownership represented by our asset class, makes a difference,
How do you feel generally about, I mean, we talked about financing, right? That the one thing is, it's not that financing is not available, it's a cost of it, right? That's the issue. Now you have a situation where Credit Suisse is gone. That was a big leverage finance lender as well. And then SVB, which was very important, as we discussed before, to the private market system. Do you see an impact on that when you look at your portfolio?
So I'll be a bit provocative. I think that lack of financing or the cost of financing is a lame excuse for not investing well in private equity. Because what happens is, so of course, what is really hard to do now is the sort of tailwind kind of investing where you take a low growth profit pool and you leverage it up to the hilt at low cost and you magically conjure higher equity returns out of that. That's sort of LBO 101 from the 1980s. That you can't do in this environment. You, by the way, could do some of that over the last decade. But what you absolutely can do in this environment is you can buy and create high growth profit streams, whether it's in services businesses or healthcare businesses or software businesses, whatever it might be, consumer brands, consumer digital. And what happens is that the pricing corrects. So I would say the journey in this kind of environment is that the volume of total opportunities comes down, but the quality of that opportunity set actually goes up because there's a bit less competition, prices have adjusted down, and the financing markets, they'll be fine. They'll be totally fine. If you take a 5 to 10 year view, they'll be okay. At a different baseline level, I think that the longer term rates that we saw 2 years ago are unlikely to come back anytime soon, so we're not assuming that. But the financing markets will be there.
Where Kurt is right, there's a massive flight to quality and differentiation now. Because if you are not global, if you don't have operating capabilities or you don't have sector-specific expertise, in this market it's very much more difficult to do deals.
I think there's also going to be a proliferation of other types of capital. So we've seen, obviously, private credit become really important. I think the secondaries market is going to be really interesting. So secondaries where they can support GPs with companies that need additional financing, and maybe if you can't get that as much on the traditional financing markets, I think the secondaries solution could be an interesting one for GPs.
How big is
to
the
turn
market
to.
by now, secondaries?
I don't know off the top of my head, but it's grown very significantly over the last 5 to 10 years.
But it's still a tiny fraction. I mean, I'll get the exact number wrong, but it's low single-digit percentages of the total, like from memory, about 1% of the total AUM under private equity is traded every year in secondaries. And it's actually, you know, our industry, maybe 10 years ago, we used to resist the secondaries market. We somehow thought that it was not good for us. But the reality is it's great that you and others create liquidity for Philipp and us for our investors in fund stakes, because that means that sort of chasm between the public markets where there's ultra high liquidity but also poor transparency, and the private equity markets where we have very good transparency into what we've invested in, and we share that with our investors and we have direct governance control, but traditionally very poor liquidity. That kind of, our asset class is moving towards having a bit better liquidity, and that's only good for us.
And there's also been an evolution in secondaries. So there's the traditional where you're buying out LP positions, but there's also the GP-led situations where we're providing capital for GPs to support those companies where they really feel like they have belief in those assets and they want to grow them and need additional capital to support that growth.
I mean, the fact is, if 4 trillion of money printing is reversed, liquidity comes at a premium. So any mode of creating liquidity is welcome. And for sure, secondaries is the place to be right now in the market, no doubt.
But what about, I mean, is liquidity an issue at all, and also redistributions to investors, because it's hard to exit at the moment? So that's, the whole cascade is a bit disturbed, I guess.
It's a massive issue. It's really, really interesting, right? So 15 out of the 20 largest GPs in the world were raising their private equity flagship funds 2022, 2023. That's unusual. Normally, it's about a third. And like a long term, normally, it's about a third. And at the same time, you have with our LP base, so the traditional sovereigns and state and national pension funds and so forth, they have seen a combination of the so-called denominator effect, your point, exits drying up, some things that could have been foreseeable, or should have been foreseeable, I should say, like subscription lines being drawn in and so forth. But the bottom line of all of that is that there's a pretty meaningful, in the more mature investors in the asset class, there's a pretty meaningful lack of capacity to invest, and then that gets spread over secondaries and primaries and the different kind of the spread of asset classes that we have. So therefore, there's a pullback of the new capital coming in fund commitments, which is great for us, because what that tends to lead to is just less competition. So whereas 2 years ago, everyone was very much on the front foot, the level of competitive aggression was high, that led to higher prices, and the level of financing was high. Now you kind of have all the inverses of that. So you have less competition, number of GPs a bit more on the back foot and distracted by fundraising or other things. The financing markets are not as aggressive, so it's harder to do. You have to come up with a better mousetrap, if you will, to get something done. Valuations are down for a good reason, and just the level of uncertainty is higher. Therefore, the need for longer-term thinking and patience is higher. So you take all of those things together, and unlike what might seem intuitive, this is actually the kind of environment that always historically has created some of the best vintages for private equity investing.
There's even one more point to be cheerful about, in addition to reduction of supply of capital for opportunities, which is the demand for what we do. If we can be value-adding investors, buying add-on acquisitions for our portfolio companies, bringing them international, helping them with the energy transition, helping them with technology transformation, is way up. Because we have never lived in such an uncertain time. We've never lived in such a time of so much rapid change. And the public markets are not really good in coping with change. So if you look at the Axel Springer take private we have done, it's a good example. the family just didn't think that, being public would be a good change agent for them to cope with all of that change. And how do we deal with ChatGPT? How do we deal with, some of the other technology changes? So I think we see more demand for what we do. Where do we find the capital? We'll find the capital. There might be short-term institutional reluctance because of all the things we discussed, but also there we have a massive change now in the fact that the interest for what we do fundamentally is broadening.
I think that fundraising cycle is an interesting topic. First of all, I think we're seeing more flight to quality. So those top GPs are finding it okay to fundraise, but those broader second layer GPs, I think, are going to struggle a bit in the current environment. But to your point, Philipp, I think it's a really interesting opportunity actually to broaden the investor base for private markets. So private wealth is obviously a really interesting area of the market that I think is going to see significant growth and interest in our asset class over the next few years.
I mean, obviously returns were good, growth is good, and private equity as an asset class seems to be quite resilient. Although, I mean, I look at the banking sector now, big banks can blow up. What about private equity funds? Where do you see the weakness?
Someone said a very good line the other day, which is that companies die of old age and banks die out of heart attacks. And it's not my line, it's borrowed. But I think private equity falls more into the private equity firms if they die out of old age as opposed to heart attacks. There's no balance sheet construct that would suddenly blow up a private equity firm. What there is if you systematically perform poorly, your investors, especially in this kind of environment where there is, to your point, a flight to quality, your investors will just say, hey, actually, thank you, but no thank you. And that happens in one fund cycle and then the next fund cycle, and then the firm is in some kind of runoff mode because all the best talent is gone. And it's the the older people that remain in the firm and can't regenerate and recreate the platform anymore. We're an intensely dynamically, constantly shifting asset class and industry. So you have to be very much on your front foot, and you have to be very both willing and able to disrupt how you think about what you do all the time.
I mean, what you're experiencing with the Blackstones, the KKRs, the Apollos is the creation of institutions from first generation founder-led firms. And the genius of these founders was to very much embrace the notion of culture eats strategy for breakfast. So they overinvested for 50 years into culture, nurturing. The way KKR, as an example, but the industry as a whole has really nurtured the next generation of leaders is through 20, 25 years of apprenticeship, right? Which, if you compare that with some of the institutions that have gone bust, is very, very different, where there's a lot of lateral hiring and lack of cultural affinity. So I think that gives us a bit of robustness in our industry, quite frankly, because it's almost like the old adage, you can make a mistake on a deal, but as long as you learn from your mistakes and you're encouraged to learn from your mistakes and people very much spend time with you on it, you'll be in a better place for it.
I think we're also evolving as an industry, right? So 20 years ago, most people were just doing buyouts as a main strategy, but now people have expanded their alternative wheelhouse. So they're now doing infrastructure, or they're doing private credit, or they're doing growth strategies. So I think that evolution to continue to grow rather than dying, I think, is an important feature of the industry.
And that seems to be what investors like, right? They go to these private equity firms and can offer multiple strategies, basically from infrastructure to credit. Do you think like those firms who don't have these capabilities will have to consolidate?
Let me start because here's Philipp's firm and ours is very different in the strategy we have. We are more in that kind of pure play plus camp. So we have a large private equity firm. We have a credit operation which has quite a lot of diversity of product, but not as much as you would have. And then we have a growth fund. And you sort of started stating an assumption as a fact. The assumption that
that's how journalist work.
Yes, and I'll just want to unpick that assumption a bit. it depends very much on the cycle. So where you have the pressure of capital coming in, and a large institutional investor says, I just want to write a 2 or 3 billion commitment, where can I put in that capital to work in a diversified strategy? Whereas in this kind of environment, it's exactly the inverse, which is, show me your performance, I want best of breed and best of breed only, and I will only back this product with this firm if it qualifies. So you get one type of environment which is very conducive to growing the platform sale, and then you get another type of environment which tends to weed out the weaker platform plays. And I think we're now in the latter. And as a firm, we're debating this a lot, because we need to ensure that we build and grow an incredibly successful private partnership-based investing platform with enough capital and, of course, access to the talent that we need, because this is, at the end of the day, it's only a talent game. And so far, the private ownership model has proven to perform better than the public ownership model when measured only by the performance of the flagship products. So far, that's been the case. Like, looking back 10 years, who knows what the next 10 years will show.
I mean, Jan-Henrik, maybe I add from KKR's perspective. I mean, I grew up in a firm. When I joined KKR in 2001, I think we were 8 people in Europe and 39 worldwide. And we just had an office in New York, in San Francisco, and in London. Now it's a truly global firm. It has infrastructure, it has real estate, it has credit, it has still private equity. From my perspective, it goes back to the culture point. As long as you can maintain and extend the key parameters of your culture to other segments, and they feel all as one team, you'll be in good shape. What you cannot do, as you diversify away from your core business, is to allow different cultures to exist. That is always the beginning of the end. I mean, as an anecdote, I remember it was so frustrating when we just had private equity and we had certain opportunities. They were just too small, or they were too high growth. We had no homes for it. So it feels like some of the strategies we added, like the growth strategies, were natural. And then in today's age, if you have energy transition, it greatly benefit from being able to go to certain places and say, okay, here's our private equity solution, and here's also our infrastructure solution. We see more and more how we come together. Telecom Italia was one example, and basically go to those firms and offer both.
I think you're touching on the core piece of that, which is really what's the rationale for why someone is doing it. So are they doing it for the right reasons, or are they doing it for asset gathering purposes? I think it's really important to differentiate that.
It's all about leadership and execution in the end.
One question to Imogen. If you look at your portfolio, do you feel like firms have sufficiently adjusted their valuations?
I think that what's happened over the last 6 months, because frankly we've been in this environment for a while, that this has been on the horizon. I think what's happened is, whilst public market valuations have come down, so comps have come down for valuation purposes, the companies themselves are actually performing fine or actually doing well. So that's kind of counterbalanced that reduction from the public markets.
Right.
In terms of the multiples that people are using. So it does feel appropriate that the valuations are where they are. And as I said, that's roughly flat. Some companies are doing better than others. I think it'll be interesting to see what happens in Q1. We might see more valuation reductions, but for now, I'm not concerned with where the valuations are.
Conscious of time, 1 minute. One more question to Philipp and to Kurt, and be very brief about it. Is the golden era of private equity over, or has it just started?
It has just started because of what Kurt mentioned in terms of the fact that the need for what we do, growth, turbulence, public markets are not good harbinger and transformation agents of that, is way up, but also the demand is way up. In an aging world where people need to generate returns, for people to live decent, retirements, you cannot just rely on the public market. So the funnel of our investors is going up from institutional investors to private wealth. And the democratization of private equity is ushering in a new golden era for private equity, in my mind.
So the case for private, responsible, long-term, impactful ownership is really strong, whether you look at performance, whether you look at the quality of the businesses that come out through that ownership, or you look at the emerging tools to create liquidity in that market for investors. And the numbers are very large today, but the penetration of the asset class is still actually really, really low. If you look at it as a total ownership model, market share, if you will, of the world. There's a long way to go, and I think there's like a fascinating next 10 years ahead of us. And there's a cycle, but that's okay.
Yeah, we are optimists, so let's not mistake that as saying the next 3 months will be easy sailing. It's going to be really turbulent.
We quote you on that. Thanks very much. Thank you so much. It was great. Interrogation over.
Thank you.
Thank you.